Good evening, reader. So this is idea number 20, I think it is. We're going to uh, just try and keep it brief. I appreciate people are busy and don't want to watch long videos, so I'll do my best. Says he. An hour later, you're like, come on, Oak Bloke. Right, okay. Anyway, Watkins Jones. So this one was one I covered back in October originally, and I guess when I looked at this was an idea that a reader had asked me to look at. Um, so when I looked at it, I suppose wasn't really a familiar, wasn't an overly familiar one for me. Not my normal hunting ground, but um, inevitably, housing sector has been in the mill, to put it politely, and well, you can sort of see here, it's gone from over 50 pence to I think it was 18 pence when I included it in my Oak Bloke 25 for 25. So um, I mean, looking at it, that obviously interest rate rises affected this quite seriously. The Grenfell disaster affected this very deeply. When you look at the background to this, I mean, the exceptional costs, you can see them here for a 75 million market cap. I mean, it's pretty much paid its own market cap in um, rectification costs to its past buildings. So it's pretty been in the wars, to put it politely. But I guess when you dissect it and you split out the different businesses, and I've done that, and also actually when you consider the cash that it held, and I sort of made the point in this original article that, well, hang on a minute, when you look at the balance sheet and you look at the current assets that exceed the total liabilities, including these provisions that potentially may or may not happen, and I started to analyze out, like, well, what had happened with these um, uh, um, cladding rectifications, and obviously a wodge of money had been spent. There was a wodge of money in on the balance sheet as a liability, and then there was also an asset, because part of the cost of these is going to be met by customers. So there's 46 million of liability that that had been expensed, and but I mean, ultimately, this the way to perhaps think about this is, whilst this has come off the previous profit and loss to go to a liability, it's this that stops it from. It's the recognition of the cost that stops the liability or the provision from being reversed back out as profit. So whilst it's on one hand, already expensed, it's if the costs don't turn out to be as bad as all that, then there's an upside to it as well as a potential downside. But of course, the reality was that more and more, and you can see the last, well, until we have received the 2H24 results, there was a big chunk that happened here in 2023 following the um, the Building Safety Act 2022. Um, they presumably, somebody looking at this in 2022 would have said, oh, we've, like, they could be saying the same as I'm saying, that, oh yeah, well, it might be a future asset, and then whop, there's a 35 million additional cost stuck on your shoulders. So and in 2H24 there was a further 7. So I think this article really just set out the stall. It made me think, gosh, this is cheap. Um, Looking at the run rate, looking at the past capabilities of it as an organization, and also the just the macro, see the demand for housing, the demand for student accommodation. So PBSA is purpose-built student accommodation. BTR is build to rent. So it's people that pay someone to build a load of houses that they are then going to rent out. and potentially some shared equity schemes, things like that as well, which is then another category called affordable homes, which is typically sort of shared ownership, that kind of thing. So yeah, look, it's yeah, I suppose the thing that struck me as well was the obviously it had a very decent pipeline. Obviously, this pipeline's not all um, guaranteed, because of course some of it is secured with planning, and other of it is sold, and other of it is subject to planning, and don't think there's any in here that are sort of in negotiation, but in the later article we see an element of that. So it's got the planning, but it hasn't been contractually agreed. Okay, and that's probably about it on that article. I then sort of did a further article a month later where I said, and I think this was following some further price falls, if I'm not mistaken. So if we go back to October, so I sort of spoke positively about it here. It got to November and it had gone and sort of declined quite a bit. What, 20% down or something. Um, and anyway, I kind of looked at it. I was like, well, this is bonkers, really, because even if you put some really, really harsh valuations against all of this, so it was 20p or 21p, even if you put some really harsh valuations against everything, like do a worst case scenario. So, this fresh business that they've got, let's just imagine that's toast. Let's just write that off. Although, I mean, in all likelihood, a profitable business that's chucking off 2 million a year of profit, like also 2.5 million of profit. I mean, could you sell that for 8 million? I mean, come on, of course you could. Assuming that it continues to make those sorts of profits. And again, we can talk about that in 2H24, that they did have a bit of a hiccup with one of their customers leaving them, and that's obviously impacted profits. But yeah, somewhere between 0 and 8, and then other things as well. So yeah, I just sort of said, well, these are investment properties worth 24. So I mean, like, could you get book value for investment properties? I mean, you know, in places like Stratford or Sheffield or wherever these places are, they're not sort of, we're not talking about sort of selling, stuff in some not very attractive part of the world. These tend to be kind of quite sought after properties in big cities that have generally sort of rising house prices. So can you get 24 for them? Almost certainly, I think yes. But let's say worst case, you can't, and you get just over half price for them for some weird reason. I mean, even applying all of that, you could sort of get to uh, quite easily get to the market, get to sort of a point where, well, 25 wouldn't be the market cap, but somewhere between there and there. I mean, you've only got to put, I think it was something like 50 million, maybe 45 million. So you only had to kind of get even like 20% towards this probable scenario, and you've broken even. And as I say, I mean, the idea that you would lose 9.2 million on property, so you're sort of selling a property worth £250,000 in Stratford for 120,000 pounds. I mean, come on, it's not very. You would struggle to sell it that cheaply, I think. Anyway, so yeah. Anyway, I kind of set the stall out there to sort of say, well, it just seems far too cheap, because even if you just wound it up and just sold the assets off, you'd make money on it. So anyway, that was the second article. Third article, so this was when I actually included it in the 25 for 25. So yeah, kind of an element of bringing together the prior two articles, and also just looking at sort of what else was going on in the market. So I read this very interesting Knight Frank survey that said that the sentiment is changing, and investors are looking to um, allocate more funds into the PBSA sector, particularly. It's the most appealing investment prospect over the next 5 years, followed by multifamily housing. So uh, yeah, it just again, it sort of seemed, and at this point it had dropped. I mean, I think I included it at 18p here. Look, and it just was, as far as I was concerned, I mean, it was just not the right price, not the right price at all. Pardon me. So yeah, I mean, I sort of said it should be a slam dunk. Obviously, none of this is advice. It's just me talking about my ideas and this. Um, uh, oh, I've got a typo there, so I'll have to tidy that up. But yeah, I mean, and, obviously with interest rates likely coming down in 2025, and well, who knows with gilt yields? I mean, we've obviously had a bit of a mixed bag so far, but rents going up. I mean, the people that you're selling to, they themselves are making more and more and more money because rents are going up because there's not many projects being built because the interest rates are high. So it sort of creates an equilibrium somewhere along the way where the rents come high enough that even though the finance costs are higher, the ROI calculation is that the return is higher, so people make those investment decisions because the return justifies the cost, the costs. So yeah, I kind of also, again, looking at sort of how rents had gone up in different places. um yeah, and also that uh that even on bad years, I mean, obviously, they'd had some storming years, but even in bad years, that it um, seemed a good business, seemed to be able to deliver profits, seemed to be able to, if you took the Grenfell bit out of this, um, what would it look like? And it looked strong. So, and obviously, then I sort of read into the Building Safety Act and what did that mean? Because again, there was a lot of just misinformation floating around that that oh yes, there's all these extra buildings that they're going to be on the hook for, and there's this happening and that happening. And I was looking at it, I was like, well, where does any of that say that that's going to widen the scope? I mean, and it was, yeah, just there was a bit of a morass of information, but it it felt like it was getting close to an end. I sort of looked at it and said, well, probably there's going to be a bit more, but um, we're talking at the time, they were quoting 2 million per building, and they were saying there could be some buildings. Uh, we didn't have a number of how many, which was annoying. But in the article I've written today, we do get a number. It's eight buildings that could remain under scope at a zero 0.9 million cost. So the cost of sorting out buildings has halved, which again, I this week I thought, well, that's very encouraging. There's quite a few things that I suppose uh, I picked up on. So look, I did a sort of valuation based upon a going concern basis. So I sort of said, well, if you compare it to, say, for example, Granger, that pretty much does the same thing. I'm not very familiar with Granger, but I looked at all of the valuation metrics and said, well, that we've got a very, very positive read across from another company that's got the same sort of situation, looking at the pipeline as well. So I couldn't help but think, well, gosh, there's like, even though the pipeline is shrinking, it's not shrinking by a vast amount. I mean, if things pick up, then that pipeline will fill and improve. And again, this week in the results, we are seeing that. So the secured pipeline, or the contracted pipeline, is dwindling, but the uncontracted pipeline has massively grown. So and it was interesting as well, just to obviously split it out into the different segments of the business to understand what's going on. But yeah, when I saw this pipeline and essentially 4 years worth of work, bearing in mind that this 1.4 is just two of the segments, that you don't really get a pipeline for fresh, which is the sort of property management. You just manage properties until they kick you out, pretty much. And then the affordable homes is quite a small business, and again, there wasn't really any um, pipeline to that. It was just they sort of track the PBSA and the BTR parts of it. And yeah, obviously here we're seeing sort of investment volumes are sort of, obviously much down from 2022 and 2020, and but I mean, it's still nearly 4 billion. I mean, it's not zero. It's sometimes I think we if you take the average there, which is about 5 billion, I mean, we're okay, yeah, so it's about 25% um, below the sort of average. Um, but again, you could sort of see some grounds for optimism. Uh, maybe it's wishful thinking on my part, but you could see some sort of, that's growing there to there, that's growing there to there, that's growing there to there. And so like this, obviously we don't have the Q4 in this report from Frank Knight, but you could sort of imagine, well, actually, that if that yellow chunk goes there, we're above the average, which is very encouraging. So um, improving forecasts, improving expectations on base rates. I looked at their website and worked through the sort of approximate valuations. I mean, I did make some estimates here. You can see I've sort of put estimate of value. EST means I've just guessed at it by sort of saying, well, a student bedroom in that city's got to be at least this much. I've sort of done, fairly, I think, conservative numbers, knowing how much things cost in the real world. But and then just number of units to kind of arrive at a value, and then I sort of grouped them by this date here. And actually, one of my readers that did this. To be fair, I didn't do it. I, I'm going to just stand on the shoulders of giants at this point. But dark green is what was delivered in 2024. So you can sort of see here, it's the completion date here, 2023, 2024. Yeah, to be fair, there are some sort of 2023s in there as well. And then these ones targeted for 2025, hence them being in this 2025 here and this 278 million here. And what I've done is I've sort of said compared to, now I have changed this in this later article. Maybe I should just be showing you this really. Let's kind of show, yeah, here we go. It's a bit bigger as well, so you can sort of see it a bit more clearly. So what I've done here is I've said, well, look, the actual for these two segments, BTR, PBSA, and I've lumped in affordable homes actually, to be fair, came to 341.8 million. So that's the 2024 number. Let's look at the approximate order book for 2025, 2026, as you can see here. So obviously 2028, there's a big gap in the forward book, but it's 4 years away, so 3 years away. So okay, yes, there is, but we've got 3 years worth of selling between now and then to fill the book. And then bearing in mind as well that these numbers here don't include any pipeline for the new fresh business. So yeah, looks, like 2025 looks pretty good. If you look at that number there, we're short by 64. And that's, by the way, that's based on news flow up till January 25. So they say in their update that there's various ones that are in negotiation, so we could see some others drop, and then you've got plus the fresh plus the refresh segments as well. But also 2026 looks good. I mean, 91 shortfall compared to this, and actually the other thing is they have done some right sizing of the business as well, by the looks of things. There, even though the sales were down, the revenue was down, they've cut the cost base by the looks of things. It's obviously there's a degree of don't get full visibility over what they've done precisely, but you get the sense that that there's some improvement there, and even the 2027 order book. I mean, short by 142, and we've got 2 years until that. And actually, the other thing to say would be that this is going to be um, March 27, thinking about it. So yeah, yeah. So this 2025 began 1st of October, so began sort of three months ago. Anyway, the day. So this was based on the full year. Yeah, I mean, this week, the share price has, well, you can see it there, back up by about 45%, which is fantastic. Really, really pleasing for those that kind of like me looked at it and went, that's just mispriced. It really is mispriced. But I suppose what I wanted to do, having sort of, enjoyed the G-force, to kind of say to myself, well, what should I do now? Now it's at 29. Should I cut and run? Should I top slice? Should I keep as it is? Should I add to it? Like, what should, and that was just what was going through my own mind. So this, as I say, it's not investment advice. This is just me rationalizing my own thoughts on an article and in a video. We're at 21 minutes. I'm doing well. We might even get the whole thing done in 30. You never know. Like, just I'll keep talking fast. So yeah, I looked at it from a cash point of view, and you can see here this net cash flow is taking. This is sort of true sales, because one of their sales was a disposal, which sort of doesn't get counted as revenue according to the accounting rules. But um, this is management account stuff that I'm doing here, so I don't have to do statutory accounts. I'm looking at what really happened, and what really happened was they sold something which, in my mind, is revenue, which they made a profit on, which was profit. It wasn't a disposal, nothing like it. It was one of their projects that they were building. It was just the way that they had to account for it. So net cash flow of 55 million. I mean, that is, as I say here, that's like, 21 pence of cash flow in the last 12 months. Net cash flow. That's fantastic. That's really good. Really good. I was really happy when I saw that. So I was like, wow, that's 1.36 price to cash flow, price to free cash flow. And so at that point, I was like, no, I'm not top slicing. No, I'm not selling. No, and anyone that does, I think you're bonkers, because, like, at that price, I mean, it's still just incredibly cheap. And I suppose all you've got to do is zoom out a little bit, something like that, where you can sort of see very, 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 very clearly that 29 pence and it's just my opinion. I'm not basing this on anything other than just looking at the numbers, giving my opinion, that 29p is still incredibly cheap. And it's, as you can see there, 45%, and it just shows how disconnected the UK markets are, that it is that, like, but at some point people kind of go, well, hang on a minute, like, when I can spend 29p to receive 21 pence worth of cash flow from something, like, you wouldn't get that from any of the mag 7. So all these people investing into indexes and stuff like that. I mean, you might get it from Bitcoin in the recent performance. Who knows? Yeah, I'll put a pound in the swear jar. Anyway, the other thing that I really liked was the available facilities. I thought, again, 143 million. Well, we can do some damage with that. The in terms of the headroom and the safety level. I mean, that again, fantastic, fantastic. And this is sort of trading and I was sort of talking about, like, asset stripping, the jolly thing, and it's generating that sort of cash and cash flow. Incredible. So this, I thought, was interesting. I mean, I call this the true picture to the P&L. I mean, it's this that goes to the P&L. Just to be clear, this is what goes to the P&L. So 8.1 million in second half was added to the P&L as a cost, offset, of course, by 1.1 of like income or offset by contributions. Is probably a more accurate word to use. But as I say, I mean, I like to kind of look at it this way. So when I say to the P&L, technically I'm misspeaking, but what I mean by that is that's kind of crystallized in the P&L, whereas this 8.1 is a provision. This is an accounting principle that you have to, or that you are, yeah, you are obliged to do based upon a kind of pessimistic assumption that you might have to pay X, Y, and Z to rectify the cladding problem, the building safety problem. Um, you know, the way that accountants have to do things is they take the provision, they sort of assume the worst, and then if it's not the worst, if it's better than the worst, then they reverse it back out, and then it becomes profit in the profit and loss. So to me, the fact that this has slowed down now, the pace of pressure on people sorting out these cladding problems hasn't slowed down at all, but the cost of rectification was 2 million and now it's zero point 0.9. I would suspect that this 4.8, and I think we were told there was 3 buildings that they sorted out in the period. It sounds like they're getting on top of it, and that, and then this might again, I don't physical inspection or any kind of knowing that it's costing them less now, but it feels like it's heading in the right direction, and that this exception might be the penultimate one. And in fact, I do say, the annoying thing has been that we just don't know how many buildings. And to be fair, that's partly because the government changed their mind and so on. And I've sort of said here, um, kind of half jokingly, like, it's not like, out of the blue, more and more illegitimate children can come forward saying, hey, I want my inheritance, that they'll know how many buildings they've got. So I think now we're at a point where Labour and the government have kind of said, look, this is what needs to happen to sort it out, but we want to do loads of house building. We've got our targets we want to hit. It's an election promise that we've made. So, 8 buildings at zero point 0.9 would be 7.2. So we might see another 7.2. And if we do, I'm sort of saying, that will take the whole thing to a sort of 5.3 cost rather than a 3.75 cost. But it seems now to be far less scary than these 30 million, 36 million. The quantum has changed as far as I'm concerned. Now, you obviously, this fear, uncertainty, and doubt brigade will argue the toss on that, and probably without any evidence whatsoever. So you've just got to make up your own mind, I think, and that these are expected to be concluded in the next 12 to 24 months. It feels like we're towards the end of this whole unfortunate episode, which of course wasn't Watkins Jones' fault. They did nothing wrong. I mean, the people, in my opinion, the people that deserve to be probably imprisoned, actually. I mean, when you look at with the installation providers, that they knew that they had a problem. And yeah, I mean, anyway, that's just from the opinion I've got from what I've seen of emails where I think they were sort of making very glib comments about how much they cared about the issue in the first place. That anyway, it's not. This isn't a political blog or a political video. This is just me talking about Watkins Jones. So let's stick to that. Yeah. So this new refresh division, there was no sign of it. Well, there was one word of it in the interim in March. So this is 10.9 million revenue and 1.5 million profit that sprang out of the air since March. They did talk about thinking about doing something in March, but there was no actual division. I mean, even if they only just double that up into an annualized, we're looking at 22 million and 3 million gross profit. But when later on, you look at the pipeline that they have, and the just the sheer scale of opportunity there. I mean, it could grow to be a massive division as far as I can see. Um, the other thing that I sort of point out in this article that I just, I mean, times change, don't they? That, and it's true actually. I know, people who are students or that sort of generation, and they are sort of flying off to Milan for the weekend and stuff like this. So that, you know, for me as a student, when I was a student, that that just wasn't normal. Whereas it's normal today. People do that. Oh yes, I'm off to Barcelona. I mean, it just baffles me actually. But anyway, the point is, from leaving aside the morality and the how do they do it perspective, should we say? The point here is that um, that increase in expectations of the quality of accommodation is a great opportunity for Watkins Jones. Is the way I'm looking at it. So this idea that it's not just about getting sign off on new PBSA, it's about tarting up the existing as well, and this refurbishing, repositioning. That universities are competing for bums on seats. The more bums on seats, the more um, tuition fees and everything else they earn. So it's a far more commercial world than it was back in the day, when it was all about the number of points you got from your A levels. And if you didn't get the points, they were like, "Go away, we don't want you." Like, whereas now, I mean, it still is that point system, but I suspect there's some people going to university that sort of say, "I've got the money, but I don't have the A level grades." Give me the money and you can come aboard, son. Again, that's just me being a bit facetious, but the obviously the number of students has increased dramatically, and this 538,000, and this is just the purpose built. I mean, that's not like the private landlords and the other types of accommodation and halls of residence as well. So there's a colossal number of students, and the overseas students, I mean, which were large when I was at university, large, very large actually, is even larger today. I mean, it's a vast British success actually, and again, we kind of uh, we look at it very negatively about these people that are coming over and you know, outstaying their welcome after they've done their degree and this and that. And it's like, well, hang on a minute, this has just delivered a load of money into our economy. Um, yeah, there's another way of looking at it, I guess you could say. Um, but again, I'm not interested in talking politics, so I'm just sort of saying that there's a lot of students. So yeah, looking at their joint venture approach as well, and how they are taking 25% equity, or maybe equity is the wrong word, but 25% stake in the project, so they get to sell 25% of the 397 beds, and sell or rent, one or t'other. And I'm not entirely clear what the commercial arrangements would be. Do you sell it back to the university, or like how does any of that happen? And actually, the other thing that was interesting is part of this joint venture is that once this is built, that it's going to drop down into the fresh management. So they make money on the building. Obviously, they're making a 12 to 14% margin on building the accommodation. They're then selling the accommodation or renting it and making getting an income that way. And certainly when you look at that 8 million, I mean, again, it wasn't clear to me that there wasn't going to be more investment needed further along into the project. But I mean, assuming that the equivalent of forward sale is that that is your investment stake for a 25% share of something worth 120 million. I mean, 25% is 30 million. So, that's where I'm getting that 21.7 from is just pro rata in it. And they sort of put these very vague, they as in Watkins Jones put these very vague rectangles that could be anything. We don't know other than maybe the size of that rectangle. Those two rectangles is about 50% of the secured value, which suggests that there's a 4 million upside rather than a 22 million upside. So I don't know. It, I mean, if the development value is 120, I mean, of course, there will be selling costs and other things as well to take off that. I mean, do notice that I say gross profit. I'm not saying net profit in that 20. So anyway, but there's an upside, and then there's a third upside, which is that they're then going to manage the accommodation under their fresh brand once it's built. Yes, I do say there actually that I'll leave you to ponder the size of the rectangles. Yes, and it's delivered through Fresh. So yeah, tossing the ammo. And nobody else seemed to pick up on this, which I was surprised at really. But anyway, the 2H24 results, these ones here, there was a big loss in the second half. I mean, it's kind of quite shocking actually that we'd gone from a very positive margin to a very negative margin in the space of 6 months. I was like, ouch. But also the affordable homes, again, I didn't feel, I mean, there was sort of some mention of, in fact, I talk about it here, that there's sort of turnaround plans to, and it was caused by a single customer moving their operation in-house that caused the fresh business to do badly. Um, but yeah, they're working towards improving their systems. So they've got Yardi BMS, they've got turnaround in affordable homes, build more smaller houses, 2-bedroom, 3-bedroom units to or get planning permission to do so if they can. So yeah, all pretty positive stuff. The pipeline, now this kind of really caught my eye, and again I was surprised that it was sort of not really, like, gosh, like these guys have now got 550 million pipeline that they didn't have 6 months ago. I mean, that's massive news. That's really positive because that's like 1.5 years worth of revenue of these segments. And there's obviously this new segment, 240 million already from a standing start. I mean, if I could start a business that would generate a pipeline of 240 million within 6 months, I wouldn't be talking about Watkins Jones. I'd be doing something entirely different. Anyway, but you get the point that that is a real success. I mean, no wonder it's gone up 45%. I mean, anybody with any sense of business is going to kind of look at that and go, flipping heck. And sorry to labour the point here, but I think it's a good point to be labouring that if you've got any kind of like, well, the size of the market, 538,000 beds that are over 8 years old that could do with a refresh, that's in a competitive market where you've got growing numbers of overseas students who like to go to Barcelona on the weekend and like to have a sauna and a gym and a concierge and a fine dining unit. And I mean, like, it's bonkers, but if that's what people want, well, the 8-year-old stuff is not going to have that, almost guaranteed, because a decade ago I think it would have been science fiction to imagine student accommodation with all this plush, yuppie yuppie standard of because it is, isn't it? To be fair, it's students have now become yuppies. There's no other way to say it. It's quite a good way of saying it, I think. And anybody who is a student of a certain, sort of early 20s, they won't even know what a yuppie is anyway. So there we go. So I'm pretty much at the end now, and I've managed to do 40 minutes. So you've probably switched it off already, and I'm talking to myself, wasting my time and not yours. But look, I mean, I think this 55 million in pipeline, 240 million not in negotiation exclusivity. Fantastic, really fantastic. And as I say, this pipe, the other pipeline is good as well. So yeah, lots of reasons to as far as I'm concerned, lots of reasons why I would not be going anywhere near the sell button. Personally. So anyway, hope that's been useful, and that's why I've included it in the 25 for 25. Um, would love you to help me with the campaign for Emmaus. It's on the Oak Bloke website. So just if you go to the Oak Bloke Substack, which is theoakbloke.substack.com, help Emmaus, and you can click that wonderful button there. 102 have. So if you like my videos, if you like my articles, there's 480, 470 something articles, lots and lots of content. So if you appreciate all of that, and especially if you've benefited personally, then think about sort of giving back. It's not for me, it's for them. They do some great work, and the money I've already been able to raise, I mean, that is a big chunk of their annual income. Well, I say a big chunk, it's not a big chunk, it's a small chunk, it's maybe 1%, but that that's made a difference to a number of people's lives, because these people are helping people who are ex-homeless, that uh, they get a roof over their heads, but they give back. They give back. The typical setup is that Emmaus have a series of businesses like shops and furniture shops, that kind of thing. And people get to sort of rebuild their lives. They work within those businesses, earn some money through that, and just rebuild themselves, get some education. So the money that 4,000 is helping people get back up on their feet and giving them a hand up. It's not a handout. So yeah, please do help if you can, if you would. If you have already, thank you. I'm not saying you need to keep giving necessarily, but yeah, it's a really, really great cause, and thank you so much to all these people that are and have given. So that's everything from the Oak Bloke. Oh, I suppose if you want to do a like and a subscribe and all of that malarkey as well, I'm not gonna object. That you get to see further videos from me. Anyway, cheerio for now. Cheerio.